So just as the retail world, food world, and digital world has changed, as we kind of just heard, so too has the investment climate shifted over the last decade. While once convincing someone to invest in your food company was an arduous task, now successful food companies have choices. Do you go the celeb route with Jay-Z or Serena Williams? Do you look to large venture firms that now see food as the hottest thing? Or what about the CPG-focused firm? Sometimes the answer is to go with the firm that specifically aligns with the mission, leadership, team, or goal of your company, the more focused choice. But how do you know when to take this potentially narrower path? Megan Bent is the managing partner of Harbinger Ventures, a firm that invests in and supports the growth of female-owned or mixed-gender-owned businesses. Today, she'll share a bit with us about the firm, as well as a larger view of why specialized venture capital may be the right choice for your business. So please welcome Megan.
Hi, everyone. Thanks for having me. I have the privilege of speaking to you all today about specialized venture capital, and I'm looking forward to sharing what we've learned in terms of what that actually means and the opportunities it can bring, but also the trade-offs. I'll try to leave plenty of time for Q&A at the end, since I find raising capital is a very personal thing, and I'd be much more interested in your questions. So first, let's get on the same page in terms of some of the expectations and foundations that we have to be aligned around before this conversation makes sense. First of all, let's be honest here. Everything I'm about to say kind of assumes that you have options and choices, and there's been some fantastic speakers today that really set the foundation for the most critical components of your business, which is to raise capital with lots of options. First, you have to have a great business, a good culture, and a great brand. And I don't want to underestimate the difficulties and challenges that go into accomplishing just that. Raising capital is a small component of it overall. The second is even in specialized venture capital, we're ultimately measuring a return. And so as you think about what partner you want to select, the concept of what are you measuring? How do you measure either return on investment or return on effort or a return on fund is really critical to understand. All private equity partners ultimately are held accountable to business metrics as well. And I find that many young brands, when they're first working with private equity, don't take the time to have those conversations around what is your business and how do I make sure it aligns with mine. So today, as we go through this conversation around specialized venture capital and how it fits your business, both of those components are really, really important to understand, which is you have to have built the right business to have those dialogues, be candidates for private equity, but also have the right alignment overall. So what is specialized venture capital? The way that I've learned to define this is it's an investment firm that fundamentally adds a new dimension or an X factor to how they're measuring return. That may be applying a different lens. It may be bringing on a specific skill set or access to resources. It may be approaching the investment structuring or process differently. But like any good specialty product, whether it's a specialty CPG brand or something else, the specialization, if it's done right, should add value to the partnership and the product. And as an entrepreneur looking to partner with specialized capital, you should hold them accountable to that as well, which is what do you do differently and how is that going to enhance what you bring to the table? So a familiar analogy to the CPG community, I think about specialized venture capital as sort of, Wegmans is to Kroger, as specialized capital is to growth equity. It's a subgroup of capital providers. They may be early adopters. They may have the ability to move more quickly. They may have the ability to take more risk. But in theory, if you partner with them in the right way, there's also an opportunity to really create a dynamic case study that can be leveraged later in the business cycle in a value-creating way. By definition, however, specialized venture capital is not a one-size-fits-all model. There's inevitably trade-offs. It may be resources or scale. Many small funds like myself are emerging in nature, and they have smaller assets under management, which means smaller checks or less deals per year. It may mean narrower sector coverage or an additional filter. They can only do sustainability. For us, it has a gender component to it. Or the partnership may ultimately be dependent upon some sort of participation, an incubator, an accelerator. And as you're evaluating your options, you have to decide if those trade-offs are a net positive back to your business model. So I'll use our fund specifically as a quick case study, not because we're necessarily the best at what we do. We aspire towards that. We're innovating and iterating as we grow, just like all of your businesses, because what I know. So we'll go through this quickly. So first, we try to create a portfolio that's more than just a collection of companies. We're trying to create a cohesive vision that's comprised of companies that are well suited to collaborate with each other. We're looking for inherent tactical and strategic synergies. We look for founders that are aligned in mission, vision, and values. We cut them into the fund structure financially so they're economically incentivized to participate and support with each other. But in order to do that, in order to really get the cohesion and the collaboration, we're highly selective. We have a very narrow mandate in terms of the business model, the sector, the life stage, and the composition of the organization. And in our belief, at the end of the day, that should be designed in a way that enhances all portfolio returns, from our returns as investors all the way through the shareholder list. It's designed to increase the ROI, the return on effort, but also that return on fun, that return on community, that return on organization. We inherently have trade-offs. What I say is we cheer on very many, but we can actually invest in very few. As part of our fund dynamics, we really do try to be supportive of the broader industry, but fundamentally, as a small fund that's making only 5 investments per fund cycle, we're highly selective. And so for a new entrepreneur looking to raise capital from us, that sort of selection process and access is probably the biggest trade-off that comes with working with us as a specialized fund. So as you are in the process of raising capital and you're thinking about, is this a fit for me? How do I access and approach it? How should I evaluate it in terms of the broader mandate? There are a handful of core principles that, candidly, I think apply to any sort of fundraising process, but are absolutely critically important when you're thinking about this specialized vehicles because of the trade-offs that are inherent in nature. So the first is, and you've heard some of this today, is make sure their business goals, our business goals as private equity investors or venture capital investors, align with your business goals. This is how you maximize the return on investment through business alignment. This comes down to understanding your category dynamics and how big the opportunity is, but also what your personal ambition levels are. Do you want to build a $100 million brand? Do you want to be responsible for an organization that requires 50 to 100 people, or do you have a different definition of success? And having a really clear perspective on that up front and being able to articulate it in conjunction with your capital partner creates much healthier relationships, so you avoid much of what we just heard about. Oop, I went the wrong way. The second is maximize that return on effort through resource alignment. And, by definition, as an entrepreneur, you're going to have like a negative return on effort. There is so much energy that goes into building a business, but you do it because you love it. You do it because you see something bigger that you want to build. You have this sense of purpose, but also you believe that the economic advantage is there. Ultimately, your private equity partner should make that return on effort easier, not harder. And that doesn't mean that there's not going to be adjustments in leadership style or new requests or evolution or maturity, but fundamentally, they should be able to show up to the table and add value where you actually need it. And here's what's critical and what my industry does not do well is stay quiet where you don't need help. Stay out of the way of the business if there's already value creation happening. This one can be hard, and this goes back to that initial concept, which is good businesses with good cultures and good brands have choice, and not all businesses get to that point. And you face a moment where you say, do I take money from these individuals or not? And I'll say this over and over again, which is take money from good people, period. You want people on your cap table, you want individuals in your boardroom that support you as leaders, as individuals, as humans, not just the businesses purely. In the adolescent cycle or in the early stage cycle of building a business, you're going through your own personal growth curve as quickly as the business is going through a growth curve. You're trying to scale the brand, the culture, the business, the morals simultaneously. And you want investors and shareholders that are focused on that return on effort, but they're also really focused on ensuring that you as a founder are growing as quickly as the business. So you maximize the opportunity that at exit, you're still leading the business that you wanted to lead. And finally, I personally believe that private equity and venture capital should and has the opportunity to really support the mission, vision, and values of a business as much as it supports the business fundamentals. This is what I call sort of maximizing that ROX factor by aligning cultures. In order to do this, you have to be able to articulate as an entrepreneur, what is my culture? Why am I building this business? What gets me excited? What are my weaknesses? Where do I fundamentally have blind spots and gaps that could affect and dilute my culture over time? And how do I make sure the capital partner that's coming to the table is aligned with the values, believes that the values create value, enhances the economic business potential of the company, and therefore fully and supports that concept. Without that, you run the risk that the business becomes more important than the culture or the values. And in our industry, where we know brand and authenticity and transparency are so critical, that can be a major business risk. So I wanted to end this conversation with just a little bit of homework, something tactical, an exercise that as you're raising capital, you can take home with you. It's a lot of words on the page, so I'll just try to run through the exercise at a high level. But I think it's something that's really important, and it creates accountability and hopefully clarity of thinking. So before you go into a capital raise, I'd really encourage you to go through an exercise where you write down the answers to some core questions on a piece of paper. You go through them with someone who's willing to hold you accountable. It could be a board member, it could be an advisor, it could be your senior leadership team if you're that sort of transparent thinker. And have a discussion with them and make sure they're holding you accountable to the truthfulness of those answers. Then as you go into a capital raise process, ask those same questions to your investors. Write down their answers. Push on them. Hold them accountable to the answers that they're giving. Diligence those questions. And then compare those lists. And again, do it in a public forum where those that have been committed to holding you accountable, your board or your advisors, say, yes, there looks like there's alignment or not. And those questions are, what are your business goals? Truly and fundamentally, why did you start this business? What are you capable of? What do you want to achieve? What do you need? And what do you want? And who do you want to work with? What type of people? And how do you build a great business? What are your reasons to believe? And is this firm fundamentally committed to positively impacting those things? And it's a hard moment when you see that the lists don't line up and they were willing to pay the highest price, or they wrote the biggest check, or they had the best reputation. But at the end of the day, you have to decide what kind of capital you want in your business with you, and if you're willing to make trade-offs in order to get all these answers to line up. And if that's the case, then you're probably a great candidate for alternative venture capital.
So I kind of want to turn the attention to you for a little bit. We talked very broadly, but what made you want to start this firm? Where did you see the white space in the investing community?
Sure. So I say this with a ton of reverence for many of my male colleagues, and I have a male co-founder colleague as well. But I'd been sitting on boards and serving as a lead investor for almost 10 years, and I picked my head up one day and realized I was the only woman in a room, and there was mostly men on the management teams, and we were consistently solving this consumer problem. And then you'd research the consumer, and she was 70 to 80% women. You thought, what a miss. What an opportunity to align your capital table with your consumer, with your board in a much more purposeful way. And so when I started off at Harbinger, the goal was to very explicitly and purposely ensure that diverse thinking was universally in the portfolio. And what we found by mandating that a female founder be in every single one of our companies is we have generally really balanced companies. My founder and I are a male-female combo. Many of our management teams are about 50-50. Our boards are about 50-50. And so having that sort of purpose, almost to an extreme, has led to really great diverse thinking. And fundamentally, we believe diverse decision-making enhances the business model.
Now, that is a wonderful goal, but investors in specialized capital often have a balance. They want to support a cause, as you said, but they also want a return. So is there a term difference that comes from supporting the cause? Are there trade-offs that kind of occur in the deal making itself?
Yeah, absolutely.
Speaking generally.
Yeah, speaking generally, I think, in our industry, mission started with philanthropic roots, but I think it's really made its way all the way to sort of capitalism in a very scalable way. What I believe is that there are many values and missions and causes that actually create value and are accretive to the business model. If they don't, then they truly are a cause. Then you have to distinguish between a business advantage, an investment thesis, a competitive edge, and a true cause. In the private equity world, our belief is that, for example, investing in women has the ability to enhance returns. We see in our businesses that ensuring that the female perspective and balanced thinking and diverse thinking across the boards and the leadership teams has the ability to enhance innovation, risk management, governance, and the data supports that. So we take ourselves very much out of sort of the cause thinking and put it in the good business practice world.
And I loved the comparison to Wegmans that you had, but with smaller retailers, sometimes there's the pressure like, oh, I have to scale up. Does the same thing exist with specialized investment, that there's this pressure on the company to eventually move to a larger firm down the road?
Companies, if they perform, they will outgrow us. And in some ways, that's something that we help try to prepare them for and participate in. And so as our brands really grow up, if we've done a great job, they're in a great position to take on true scalable private equity in a way that maintains their core values and their business ethics and the balance that we've been supportive and creative of. So we try to be very symbiotic with many of our peers in the industry. We're very appreciative of non-specialized VC and more traditional private equity, strategic support, and angels. We're just one piece in the broader puzzle.
And it somewhat seems like working with someone like Harbinger might prepare you so that when you take that larger capital raise, you feel more, stronger and more confident in the values that you have.
That's absolutely our hope. I mean, we say we measure two primary KPIs. The first primary KPI is obviously risk-adjusted returns. Our business grows and we're sustainable when our shareholders generate good wealth creation. So that's critical. But the second KPI, and this is one that we hold ourselves accountable, is the success of our founders. We like to see every single entrepreneur that we invest in achieve their own personal goals and ambitions, whether that's as CEO or Chief Brand Officer, CFO. We like to surround them with the resources, support, network, community, and infrastructure they need to grow. That sort of transition from an entrepreneur to a CEO is a massive evolution. It's a high-risk evolution, and it's one that so many are not successful in making. And we really try to make sure that we're supporting the governance, the operations, and the cap table, surrounding them with the right people to accomplish that. So when private equity comes in, they're ready for the big leagues, so to speak.
One thing I've heard from brands around specialized venture capital, for example, in the plant-based world, is, I don't know if I want to go that route because they're kind of also investing in my competition. Do you have any words of wisdom about, how specialized capital can bring their brands together in their portfolio versus have them sort of competing against each other?
Sure. It sort of goes back to that net positive equation, which is you have to decide if some of the risks or trade-offs at the end of the day are accretive to what you're trying to accomplish. What we've seen over and over again is one of the greatest benefits of specialized venture capital is the community and network that's created and how accessible it often is and how relevant it is. In Harbinger's portfolio, for example, all of our founders are connected on Slack. We bring them together for very regular, I have lack of a better word, lunch and learns, and they're on topics that are universal across the theme, across the portfolio. And so while in theory they may be competing for share of wallet on the consumer, or they be similar adolescent life stages trying to grow up through retail, there's a lot of learnings that they can generate operationally from a sales and marketing perspective or leadership that we believe are, at the end of the day, very positive back to the portfolio.
If you're one of those people who maybe is like, ugh, I don't want like team building exercises, like I'm kind of a lone wolf type of person, is specialized capital maybe not the right fit for you? Because I hear from a lot of these firms about like, yeah, we have lunch and learns and Slack groups and we all get together. And I'm sure there are certain people who like, that's just not them.
Oh, I would say most entrepreneurs fall into the category of maybe lone wolf is too extreme, but that idea of my business is my whole life.
Yeah.
And so everything that I do, personal to professional, goes through the filter of, is this going to generate value back to my business? Is this really good to my business? So we're very respectful and mindful of that. I think being returns first, business first, growth first, operationally first is why we're able to work with really talented founders. While specialized capital to access within entrepreneurs if they prioritize differently. So really understanding your entrepreneur base and making sure it's a good fit is important. But I always say, all entrepreneurs at the end of the day, they're really trying to make an impact, generate something really big, do something important, and make money. And so everything you do as a fund should be aligned and mapped to their priorities, or you're just getting in their way.
And on that note of aligning goals, you said, make sure you take money from good people and make sure your investors align with your goals. Sometimes when you're a brand and you're taking capital, you hear a lot of things, and then you take the funding and you go home, and it's not always necessarily what is sort of said. Or you have different opinions of what that exactly means. So how do you figure those things out? How do you separate like the fluff from the fact, kind of?
Yeah, so let's start by being really honest here. Entrepreneurs should reset expectations and understand that as venture capitalists, private equity firms, we have done such a great job of marketing ourselves. So we really have dialed in how to market, how we add value in our network, et cetera. At the end of the day, the business value is most importantly going to come in the business. And so as an entrepreneur, sort of level setting your expectations about what an private equity or venture capital firm that has tens of portfolio companies is actually going to be able to do for you is sort of a nice way to set the bar low enough that they're going to get over it. But the second is, they should be able to do something. They should be able to show up and not get in your way. They should be respectful and excited of your business model. They should be able to ask smart questions, hopefully connect the dots between some of the financial KPIs back down to the strategy and operating capability. And that's something that as an entrepreneur, you can vet. Reference calls. As an investor, I put our entrepreneurs through sort of mini case studies to understand how they think. Throw out some bogey questions. Say, how would you solve this? How would you think about this? Gives you a great sense of how they may run their business. And you can do the same thing back to your investors. Take the time to diligence them by asking them hard questions, finding people that have worked with them before, and understand what they're really capable of.
Now, this idea of having them add value where you need it, and I think you had it on there as staying quiet where you don't need help. How do you realize if you actually don't need help in an area or you just don't realize that you need help in that area? Because sometimes I talk to successful entrepreneurs and afterwards they're like, oh, I thought I had this down. I did not have that down at all. So it's good their investors chimed in.
Oh, yeah. I mean, this is like a self-awareness question, right? We could go on forever on this. I think there's two things that you can look at. One's qualitative and one's quantitative. On the quantitative side, numbers speak. So, one blind spot I see for entrepreneurs a lot is they'll get a little bit behind on the hiring curve. I don't need a VP level so-and-so. It's too expensive. I've got control over this. And then you start to see some financial impact. You're short shipping customers. You're holding a little bit too much inventory. Your margins don't look so good. So as a CEO and a founder, really sort of staying dialed on your financials and understanding the insights they're communicating, that's really important. I think the second is on the qualitative side, it's a more of a self-awareness exercise. It's really understanding sort of patterns around your behavior and asking for that feedback from your board so that you have a sense of where your blind spots tend to be and having the openness and collaborative thinking to say, you're right, this is probably maybe the second time I've gone through this, and I'm going to listen this time around.
With this self-awareness piece, has there ever been a time for you where you've really, and not asking for specifics, where you've really wanted to invest in a company and you realize like the financials aren't there or the company's not there, but you're just super passionate about the founder? That seems like that would be kind of a hard thing to tease out sometimes.
Definitely. Yeah, there have been many examples of that where there's an individual that has such a beautiful capability to create a brand or an excellent product or a big vision where you think, wow, this could really have an impact on the consumer landscape. But you dig into the business model a little bit and there's no execution behind it. And at the end of the day, really good entrepreneurial businesses are built by three things. It's a unique and differentiated and scalable vision that feels almost defensible in some way. The second is execution, right? An ability to put that into motion, and that flows through into, can you sell the product? Does the retailer want it? Does it have margins that are sustainable? Do people want to come work for you? Do you know when to hire the right people? And then the third is grit. Do you have the ability to get up when you get punched and stand back up, do it again and again and again and again? And there's been numerous entrepreneurs that hit one box but not the other. And you love the product, you love the brand, you love the person, but you say at the end of the day, this isn't a private equity candidate because, like I said, we run a business. And so your business goals have to align with ours. And if it doesn't, don't take money.
Well, those are some strong words to end on. But thank you so much for sharing your journey and how you look at investment. I really appreciate it.
Thanks for having me. Thanks, Carol.